Good morning, everyone. Welcome. Thank you for being here. We have nice weather today, so that's always good, although it's a little bright up on the 44th floor. All right, so we're going to get right into it, actually. And we, of course, love to ask you guys what you're thinking. So we're going to kick it off with an audience poll. You need to join either via slido.com and enter in that code, or you can use the QR code. And we would love for people to get voting on our top question of the day, which is which macro developments in 2025 surprised you the most compared to expectations at the start of the year? Now, while everyone is getting set up and voting, I also wanted to highlight we have some bingo cards on the table. These are our handout. The strategy team, Zach and I sit in Charlotte, North Carolina, and sometimes we just start chit-chatting, and we thought it would be fun to survey the CreditSights analysts and see what is on their bingo card for 2025 or 2026. What do they think is, maybe going to happen, maybe kind of a left field event. And it was really fun to see some of the responses that we included on the card. Some of them we did not include because they're not necessarily safe for public distribution, but it was really funny to talk to all of the analysts about what's kind of in their framework. I'm going to have my fellow panelists introduce themselves. So Zach, do you want to kick it off?
Yes. Hey, everyone. Good morning. I'm Zach Griffiths, head of U.S. investment grade at macro strategy at CreditSights. Excited to be here with you all today, and thank you for coming out.
Great. Thank you, Zach. Thanks, Winnie. I'm Pat Luby. I'm head of municipal strategy at CreditSights. I've been in the muni business 30 plus years and with CreditSights 8 plus years. I'm also the fixed income ETF guru here at CreditSights.
He really is the ETF guru. If you ever have an ETF question, ask Pat because he knows the mechanics of it so well. All right, so we've given the audience a little bit of time to vote on our macro development surprise. And perhaps not surprisingly, global economic resiliency to tariffs tops the list in terms of the surprise, followed by credit spreads reaching new post-GFC tights. So Zach, you were actually at our London conference last week, and we asked the London audience the same question. Are you surprised by the results here, or is it kind of the same?
It's very similar, Winnie, with global economic resiliency to tariffs in the number one spot with about 2/3. But second over across the pond was the gold rally. And new spread tights was third at 13%. Gold rally was about 15%. So it seems like a little bit more surprise in the room about credit spreads heading to new GFC tights relative to what we heard in London.
That's really interesting. So I guess everybody in this room was buying gold. They're not surprised
Yeah,
by
apparently.
it. Hopefully that's the case. I was not, unfortunately.
Buying drinks later then.
Yeah, definitely. Okay, so let's move on to the strategy team. So Zach, what was your biggest surprise for 2025? And then what tangible takeaway or lesson learned are you bringing into 2026?
So I think the economic and financial market resiliency to tariffs is certainly up there. I think corporates' ability to navigate tariffs is a big one, and just the financial market resilience to kind of all of the headline news. But I think the two concrete ones for me are just how strong the technical was in 2025 with money market mutual funds kicking off a ton more interest that's seemingly getting redistributed within the financial system. And I think the breadth of the impact of AI on not only the economy, but financial markets, thinking about the wealth effect and seeing equity multiples continuing to rise on that optimism, fueling growth in the consumer in the upper half. And so I think the big thing for me, at least in terms of lesson learned, maybe we underappreciated a couple of those factors. But importantly, we think that those are going to shift from major tailwinds to either less of a tailwind or more of a headwind from the AI and all of the debt finance CapEx in 2026. So I think that those factors are still prevalent, but are going to have a different impact on markets broadly next year.
All right. How about you, Pat?
So coming into this year, one of the things I was expecting was an increase in new issue supply for the muni market. Was expecting a second year of record volume. We're on track to get that. Was also expecting that there was going to be a sharp increase in net supply, so reducing new issue volume by the amount of bonds getting redeemed. Was looking for that number to come in around $200 billion, which is an enormous number. But I was expecting that enormous net supply was going to be a technical headwind for the market. What has surprised me about 2025 has been the incredible strength of demand from individual investors for tax-exempt munis. Munis have done extraordinarily well. The front part of the curve is priced for perfection. I was really expecting more volatility this year.
Yeah, same. I was also expecting more volatility. I think a lot of people were. And I think that that was my big surprise takeaway coming into this year. We identified that there was going to be a wide range of policy changes. And when we looked back in the playbook, trying to assess, what's maybe a similar year that we can think about, we had identified 2018. That was trade wars kind of around one. The Fed had been hiking rates, not nearly to levels where we are currently. And we did see a pretty significant spike of volatility. Now, it was at the end of the year, so we still have some time if we want to have that 2018 playbook. But, just for context, that year IG spreads went from 90 basis to 163. For reference, we got to maybe 110 on the index during April's Liberation Day kind of chaos. And I'm kicking myself in retrospect that we didn't go overweight then, because spreads have just been on kind of a relentless, stable tear tighter. Also, when we think about spread reactions to labor market weakness, even as recently as 2024, it was much more significant than some of the moves this year, as we got not particularly great labor market data. And so I think that the big lesson learned, and this is probably a lesson we should have known, because we got it right in the end of 22 and early 23, even into 2024, is you can't underestimate that power of cash that had been injected into the financial system through easy monetary policy, through fiscal stimulus, and just trying to identify how long that kind of lingering cash papers over a lot of the more negative headlines or kind of fundamental stressors in the system is a really open question at this point. So let's turn it actually to fundamentals. And Zach, this is where it's your time to shine. How are you thinking about the macro backdrop in 2026? Do we think that the Fed's SEP yesterday, which was pretty darn bullish, if I say so, is a realistic outcome?
It's a possible outcome, I'd say, Winnie, and thinking about our probabilities, we put about a 30% on our bull case. That kind of seems to be very consistent with what the Fed signaled. But our base case is a little bit more cautious, and I'm just going to take us quickly through some labor market inflation expectations and how that fits into our rates outlook. You can see on this slide that our base case is for the unemployment rate to rise to 4.7% in 2026. Consensus is around 4.4%. The Fed came out with 4.4% yesterday, which I think is unchanged from September. So we look for job growth quite a bit lower than consensus, maybe in the 25 to 30,000 range. And we've got a bunch of numbers on there. You can go through how the labor force participation rate and all of that fits in. But I think this lower supply is not going to necessarily offset what we think will be several months of actual job losses in 2026, which is going to be the key to starting to see the consumer crack. You're already seeing that in some sentiment data. You can see in the chart on the right, just thinking about sentiment around the possibility of finding a new job in the past 3 months that hit a cycle low in August. It has rebounded a bit, but we are looking for an inflection point in the labor market. It's not a terribly high unemployment rate, but it's quite a bit above what the consensus is calling for. And I think it's going to feel a little worse with a more vulnerable consumer, perhaps than the headline number suggests. And with that kind of labor market consumer-led slowdown, we are looking for inflation to continue moving lower. If you look at the middle chart here, you can see that about 2/3 of the last 3 months of inflation has been demand driven, actually. And we all talk about tariffs all the time, but right now demand is in the driver's seat. And if we have this labor market slowdown pushing the consumer lower, we think you could see demand driven disinflation, which allows the Fed to cut more than what they indicated in the SEP yesterday, what the market is priced for as well. And so thinking about the path, I think inflation can stay elevated in the first few months, maybe the first half of 2026 before moving lower, kind of akin to what we have in that red dot, which is really a move back to a very longer term average over the past 15 years. I think maybe that light blue line over the next couple months could be realistic as tariffs finally start to flow through to the numbers. The last thing I'd say on inflation is market-based inflation expectations have come down. The curve has steepened or disinverted a bit. And so I think One of the big things for us on top of this expectation for inflation to move lower is commodity prices have come down a bit, and we look for oil. Our analyst Chaz Johnson has oil around $55 per barrel. We've done a lot of that move already, but not looking for a big uptick from here. So weaker labor market, demand-driven disinflation is what we're looking for in 2026. Now that brings us to what does this all mean for the rate backdrop? And maybe I'll start with the chart on the right here. That looks at our calls for the shape of the curve relative to forwards, relative to consensus, and we also have our probability weighted scenario in there. So we're way lower in yield, steeper in curve than what the market is priced for. That's really driven by our slower growth, lower inflation, weakening labor market expectations. And so I think two things strike me about that chart on the right. The one is if you look at the forwards, there's definitely more concern about the very back end of the curve still, kind of that fiscal concern outlook. We're a little bit, I'd say, less concerned at this point than certainly where we were last year, because we think that as the Fed is able to resume cutting later in 2026 and we see this deterioration in the labor market, we think that kind of shifts focus, and long duration will work well for total return investors, not so much for excess return. Two quick things on the left chart, looking at the breakdown of real yields and break-even inflation expectation. Real yields have been pushing the nominal yield lower. We expect that to be the driver in 2026, with real yields going to about 1.25% to 1% or so, not looking for a big move in break-even inflation expectations, which you can see have been very stable. Looking at the market today relative to our fair value estimate, it's around the widest dispersion we've seen in the history of our analysis. Our current fair value estimate is 3.75%. Given how we expect the Fed and market pricing for the Fed to unfold, that should move lower and kind of supports our lower yield call in 2026.
Great. Thanks, Zach. So as we think about that macro backdrop of more construction on duration risk, a little bit cautious on the labor market and not necessarily expecting a reacceleration of inflation, how are we thinking about the world of IG credit? How do you think kind of the spread landscape could unfold, and any notable mentions on the bull or bear case scenarios?
Yeah, so we're underweight U.S. investment grade for excess return focused investors. With that, we look for spreads to widen to 120 basis points, which is a pretty big move wider from where we are today. Not necessarily a wide level historically. You might remember us saying something similar last year. I think the big shift that we see in the year ahead is kind of on the fundamental side with some of this tech investment that we're going to talk a lot about today. We think that's going to be more of an overhang for the market. And of course, this weaker economic backdrop, which really feels hard to imagine with how robust economic growth has been over the past 3 years. That seems to have been a huge concern maybe back in 22 and 23, not as much of a concern today. We think the market is underappreciating that risk. So we did notch up our base case scenario to 55%. Took down the bull case to 30%, which I mentioned earlier is basically what I'd say the Fed is calling for. And that's certainly a perfectly possible outcome. And in that scenario, we have IG spreads moving to 65 basis points with high yield at 225, kind of in this Goldilocks scenario. Probably not a lot of need for more rate cuts just because the economy holds up well. Maybe inflation is a little bit stubborn, but I think that trade-off between maybe the labor market not deteriorating as much, the Fed can keep the policy rate higher, but that's not going to be a problem. So our bull case, or excuse me, our base case is definitely a little bit less optimistic than the bull. If you buy the Fed's call, then it's going to be another great year for markets in 2026.
All right. Yes. And so on the high yield side of things, just quickly, because I realize this is a more IG oriented audience, but I do think it's important to just kind of consider what has happened in the world of LevFin this year, where there's been very strong total returns in the high yield market, a little bit less so in the broadly syndicated loans, but that's been effectively all up in quality. If you think about triple C starting yields north of 12%, they have underperformed double Bs this year. And so that really just indicates how much of the performance has been more duration oriented and up in quality risk taking rather than a true kind of reach for yield. And a lot of LevFin people have really been saying, we need rate cuts. We need rate cuts. That's what's going to kind of keep things going. But I always push back and say, why are we getting rate cuts? Is it a reaction to something that has gone a bit wrong and that's going to have a reaction function for spreads and risk? Or is the Fed going to continue to be kind of proactively easing? And I would say, given some of the headlines from yesterday's Fed meeting and the silent dissenters, it might get to be a little bit more of a challenging path forward. And that will definitely be an interesting thing to unfold in 2026. So, Pat, let's loop in you on the muni side of things. The muni market has also garnered a lot of headlines this year. We've seen a lot related to universities, to healthcare and hospitals. How are you expecting fundamentals to evolve in the muni market over the course of 2026?
So I think broadly speaking, fairly constructive on fundamentals for most of the muni market. State and local government tax collections of personal income taxes, monthly collections, they're actually in pretty good shape. Some of the states are seeing good, strong collections in personal income tax collections. Sales tax collections are a little bit more of a mixed bag, but they're generally flat to up a little bit. They had been up more because of the inflationary effect, and that's going to moderate a little bit going forward. So for state and local government finances, I think the revenue side mostly looks okay. The sector that remains the most interesting and has been the most interesting this year is the colleges and universities. And of course, the large colleges and universities, some of them borrow in the investment grade corporate market. There's a number of colleges that have bonds in the IG corporate bond index. They also borrow in the tax-exempt index. We expect continued, headline risk in that sector. The demographic challenges are not going away; they're increasing. The political risk that the sector is contending with is going to continue, and the way schools are going to respond to the political risk, we're seeing some variation. So I think, especially on the tax-exempt side, where munis are very subject to headline risk, there could be some spread widening independent of fundamental credit risk. We saw that in 2025. Harvard was trading well behind the AAA as people were fleeing AAA-rated Harvard, which is clearly not going to go out of business. So I think we'll see some more of that volatility in the year ahead. But here we have a prospective look at potential returns for the muni market for 2026 because of the strong carry on munis. You get a head start on the total return because of the income return. The key point takeaway from this is yields could go 60 basis points higher, and the broad muni indices could still pretty much break even for the year. That's not our rate call, obviously, but for those looking for how much insulation is there against an adverse or surprise move in the market, the carry provides a lot of shelter.
Yeah, that's a great point. And I think that's one of the reasons we're much more constructive on that total return dynamic, especially in investment grade. You still have a good amount of carry and ability to widen out and break even. All right, so we're going to ask the audience another question now that we've talked a little bit about the fundamental backdrop. We would love to hear from you. Which credit markets will be the most sensitive to fundamental change in 2026? Europe, the U.S., emerging markets, which have been on an absolute tear this year, all of the above, or we're going to continue to just be fighting that technical tailwind and fundamentals don't matter. So, Zach, you were in London and we asked this conference as well. I would love to hear what the London audience had to say about the responses.
Yeah, I think it was interesting, Winnie. Typically, I think of Europe as pretty optimistic about the U.S. and downtrodden about their own prospects. And maybe I had been hitting the U.S. fundamental concern drumbeat pretty hard, but the number one answer was the U.S. at 48%, followed by technicals still going to overshadow fundamentals. Europe was in third place at 17%, EM at just 6%, and all of the above, which has 0% here so far, was 4%. So I think it's interesting to see Europe a little more concerned about the U.S. in terms of the fundamental backdrop, and maybe not to see as much optimism about the technicals, which have also been very strong in Europe, to kind of be the overarching driver of markets again in 2026.
I think arguably the technicals have been even stronger in Europe and EM, where inflows as a percentage of AUM is well above that of U.S. markets. I once had a European client tell me that when Europe is good, the US is better. When the US is good, Europe is bad, the US is better. So it is interesting to hear that some of the European investors are feeling a little bit more optimistic, perhaps.
Yeah, I think one of the interesting things that came out of that conference, talking to Logan, and we did an external panel, is thinking about the euro market is now primarily comprised, or at least majority of U.S. domiciled companies. And when we were talking about the potential for tech issuers to start tapping the reverse Yankee market, the idea was there's plenty of capacity because many of these hyperscaler names have not tapped the market in some instances 10 or 15 years. But when you think about that country risk, does that play a role, and will there be some pushback there? That's another thing that we think will be interesting next year.
Absolutely. So this audience thinks that, again, we're going to have a year of fundamentals overshadowed by technicals. Hopefully that means positive technicals, not negative technicals. All right. So let's talk a little bit about the fundamentals and digging into some of the more recent trends. I did a presentation earlier this week, and another strategist was on it, and he basically said that 2025 has been a kind of as good as it gets for US corporate credit from a fundamental perspective. And that really resonated with me because we've seen a really kind of long running upgrade cycle from a fundamental perspective. It started with corporates kind of post COVID, with a lot of those fallen angels getting re-upgraded to rising star status. And now we've seen that expand into the financials world, as a lot of the regional bank volatility has been met with kind of re-upgrades and positive rating momentum. It seems like at this point, some of that positive rating momentum might be beginning to plateau, and not the least because companies are much more willing to be a bit more intentional with their balance sheets and using them for different types of M&A, financial engineering. We'll hear a lot about all of the spending that is going on across a wide range of sectors when we think about kind of the AI infrastructure play. And with that, we think that we have to be paying attention to the potential ratings momentum and how surprise or even not surprise downgrades can result in kind of a repricing of risk. We've definitely seen some single name kind of idiosyncratic things happening, especially in, say, the chem sector, which has been quite downtrodden for a couple of years at this point. And when we think about the ratings outlooks, especially for triple Bs, it does feel like on the corporate side of things, there's a little bit of a negative skew overall. We also think about, what's left on that rising star and fallen angel list. Our analysts are great, and they work with us every quarter to put together a list of names that they have a high conviction level of either upgrade or downgrade over the next 12 months. They've gotten so many of these right. And at this point, the rising star list is pretty short and not a lot of big capital structures. Really, it seems like Carnival's kind of the one left on the list that is really substantive. Now, the fallen angel list is similarly not massive, but it does absolutely outweigh the rising star potential list by about 2 to 1. And so that is something that we're just kind of thinking about and keeping in mind. Now, when I talk to high yield asset managers and high yield traders especially, they say that they would love for those cap structures to get downgraded so they have something else to trade, given how much that asset class has been shrinking for the past few years. But it's a be careful what you wish for type of situation. I also want to just kind of briefly mention default expectations. Earlier this week, we put out a comprehensive special situations outlook, and we also updated our 2026 default forecasts. We don't have a particularly aggressive default expectation in 2026. We see high yield moving in the 3.5% to 4% area. It's been kind of in the low 3% area for much of this year. We expect that broadly syndicated loan defaults are going to continue to outpace high yield defaults. And then we've also observed a pickup in private credit defaults. Now, a lot of those have been because there are still covenants in private credit. So if you have a maturity extension at par of a distressed issuer, that could be considered a default with, zero loss, at least for right now. But it is an interesting dynamic to see that the private credit default momentum is starting to pick up a bit, kind of lagging that of high yield, which had its default cycle kind of first, and then broadly syndicated loans, and now private credit overall. So let's turn to some of the sector-specific nuances. And Zach, I think that sector strategy actually mattered in 2025, despite kind of good performance in aggregate, there was a wide range of performance at the sector level, especially on an excess return level. We saw media massively underperform, financials post another really good year, technology spreads repricing quite considerably. So as we think about balancing kind of our quantitative analysis, we do this Z-score analysis every month at the sector level, and then what our fundamental analysts are saying about sectors. How do we calibrate sector strategy for 2026?
Yeah, so you can see in the table on the left here, definitely some sectors screening as cheap and rich, some good bifurcation. And in this table, we look at a shorter Z-score, so a 1-year look back instead of the longer term look back that we do. The big thing that jumps out is tech already looks cheap, but we think there's a paradigm shift underway in terms of what balance sheets will look like as we kind of seeing this hyperscaler CapEx evolve. We'll go into that in more detail in later panels. And when I think about, considering how things look on a relative value basis versus fundamentals, I feel like thinking about the relative value is helpful, but it's kind of outweighed in most cases by our fundamental view. And so I think some of the interesting upgrades and downgrades that we have, telecom and cable in IG, we have upgraded to outperform. We think that spreads are attractive. That does screen as cheap, and we see it as kind of a defensive sector. If we do get this consumer-led slowdown, telecom is well positioned to probably feel less of the pain than other parts of the economy. We updated transportation. This is a little bit of a different view with a technical tailwind, especially in rails space with the big merger pending, looking for less supply there. That's also longer duration for our total return focused investors. That's a good place to get longer duration exposure in our view. Two of the big downgrades we have are consumer goods, kind of looking at that sector that also trades rich and considering maybe some of the more discretionary sides of that sector. That's not a place we want to be with tight spreads and concerns about the consumer. And then tech, we've downgraded to underperform. I don't think I need to mention any more on that. I guess the last thing I'll say is we are still outperform on financials, which have performed well. And when we think about this consumer slowdown narrative that we're hearing from our consumer and retail team, I'd say our banks team pushes up against that a little bit, as the banks have been more optimistic in terms of what they're seeing from a consumer balance sheet perspective and even a spending perspective. So it's kind of interesting to see that bifurcation, but we are sticking with the outperform on U.S. financials for the third year in a row, perhaps, but have a little bit of a different thesis behind it, going from spreads having widened so much across the whole space to spreads looking a little bit more normal, but still some pickup left there and what we think is going to be a more resilient sector than perhaps it had been historically.
Great. Thanks, Zach. So we have another question for everyone. We would just kind of like to know what markets you all are focused on. And so we have in which markets can you invest? Corporates, U.S. corporates only, U.S. corporates and munis, U.S. and Euro, U.S. Euro, and EM. And I just wanted to highlight, we do have a global strategy team at CreditSights. We put out outlooks for the U.S., Europe, EM sovereign, and Asia markets. And you can always reach out to us and any of the analysts on the strategy team. Zerlina, who is our head of Asia strategy, has been wildly helpful navigating this year, trying to understand what clients in Asia are doing. She was great, especially during all of the April volatility and chaos and kind of the sell US messaging, because she was hearing not that from clients. And so that's really helped us get a lot of the themes correct this year and understand what the global investor is doing. All right, so U.S. corporates and munis are at the top of the heap here, and then U.S. corporates, U.S. and Euro, U.S. Euro, and EM. I do want to highlight that we also updated our Euro recommendations. We actually are neutral Euro IG corporates relative to underweight U.S. IG corporates. And a lot of that is predicated on some of the fundamentals and technicals, which we think might be a little bit better in the European markets next year relative to our expectations for this year. All right, so let's move into some of the technicals. If they're going to continue to be such a driving factor in 2026, Zach, I'd love to hear from you. If we see the Fed cutting more than anticipated, what does that mean for that cash tailwind that has been so supportive to really every market this year?
So we are looking for that tailwind to fade, you can see the chart on the left here. We look at money market mutual fund balances and then just compute how much interest would be earned on that cash pile using the Fed funds as a proxy for what you can earn. And it's interesting, if you look at the past 3 years on average, it's been about $300 billion of interest earned on your least risky product in your portfolio. And I think that's something that, thinking about those numbers, almost $1 trillion over the course of 3 years, it's almost like a lagged fiscal stimulus, as you have such high budget deficits and the public owning so much more of these T-bills, which actually earn something. You look at the whole 2010s, you pretty much didn't earn anything that whole time frame. And so I feel like that's not something that's widely discussed in terms of how it impacts markets, and has been more of this staying factor in terms of some of the pretty wild stimulus that we experienced post-COVID. So that $300 billion per year number actually roughly equates to what we saw in terms of US IG inflows over that same time frame. So looking ahead, with the Fed cutting around what we anticipate, which is 3 cuts in 2026. I don't know if I explicitly said that earlier. That's quite a bit more than what the Fed anticipates, a little bit more than what the market is priced for. We see that tailwind fall about 22% to call it around $240 billion. So that's still probably a pretty substantial.
What's $100 billion between friends?
Exactly. We're not saying that the technicals are going to completely fall out of bed, but when we think about how much more net supply we're going to see next year, I know, Winnie, you're going to talk about that in a minute. I think that dynamic shifts a fair bit. And so I think that's one of the big drivers, and maybe this shifting landscape is a little bit underappreciated, and maybe it doesn't come to fruition if the Fed stays on hold all year. But in our base case, that's really been that will kind of fade as we look ahead to next year.
All right, so that fading cash tailwind. And I want to talk a little bit about our new issue expectations for investment grade. When we put together our forecasts, we work with our analysts to do kind of a bottoms up. That is in all of our sector outlooks that were released right before Thanksgiving, all of the issuer expectations for the primary market. And the bottoms up forecast from them was actually not that punchy. It's about 650 to 700 billion. Now, we do add to that because there's always going to be something else coming to the market. Issuers get proactive. They want to kind of pull forward refinancing activity. We know that there's a lot of M&A happening right now, a lot of investment. And so our forecast is 1.4 to 1.5 trillion, which is at the low end of sell-side expectations, per my understanding. I think some strategists are out there as high as 2 trillion for next year in gross supply. And I totally understand that impulse to take forecasts up. New issue this year has been, I think, more elevated than a lot of people anticipated coming into the beginning of the year. And of course, we've seen that M&A and headline calendar pick up quite considerably. But given that we have a more cautious view on spreads, it's very difficult to have a really robust new issue forecast when you are expecting some degree of spread volatility, which is likely to weigh on the primary calendar in fits and starts over the course of the year. We also want to highlight that while there are a lot of refinancing needs with maturities totaling about $1 trillion annually in the next 3 years, we've seen a lot of proactive refinancing over the past couple of years. And so thinking about how much of that activity has actually been pulled forward, when we look at cash sitting on corporate balance sheets, it's still really quite elevated. And we do think that as the Fed is cutting rates, that ability to kind of act like a bank and have a high kind of net interest income, if you are just sitting on a lot of cash as a corporate with a very low cost of capital debt structure, is going to start to be a little bit more challenging overall. And so we do think that new issue is going to hang in there, but not necessarily be quite as elevated as expected. So Pat, what trends have you observed in the muni primary market, and what do you expect to change in 2026?
So I alluded to this chart earlier talking about net supply. So what we have here is above the line is annual new issue supply in the muni market. And you can see that this year we're on track to come in around 575 billion. Our forecast is for 600 billion of new issue supply next year. Below the line is the amount of bonds maturing and redeemed every year. From 2017, which is when our data begins, through 2023, I think that is, the average net supply was only about $21 billion per year. So to clear the new issue market, only $21 billion of net new money needed to come into the market to clear the new issue supply. That began to change in 2024. Over $100 billion of net supply in 2024. This year, it's going to come in over $200 billion. And our expectation is that for 2026, that net supply is going to be around 250 to 275 billion, meaning the market's going to need $275 billion of new money to come into the market to continue to clear the market. I don't see anything on the radar screen that makes me concerned that there's not going to be sufficient demand to continue to clear the market. But the caveat there is if that demand breaks or slows down or reverses, the next natural buyer for tax exempts are banks and insurance companies. And munis, because they're priced for investors at a 37% tax bracket, if they stop buying, extreme volatility in the muni market, similar to what we saw in COVID. And similar to what we saw in COVID, the volatility, or even in April, extreme volatility absolutely draws banks and insurance companies in the market. They crave muni credit risk in their IG portfolios. If munis back up enough, those buyers will absolutely be there and they will soak it up, and those spreads can tighten up pretty quickly. So again, I don't see an interruption for the demand, but if that demand slows down, extreme volatility, the best way to watch as an indicator of that demand is a combination of mutual fund flows and ETF flows. We publish on that on a regular basis. We're out this morning with our update. Make sure you're looking at those separately. Mutual funds should be tracked separately from ETFs. So that's it there.
Great. Thank you, Pat. All right, so let's move on to expectations for 2026 from a risk perspective. We would love to hear from the audience what you think the biggest risk to global credit is in 2026. Of course, that AI pullback is on there, credit downgrades and defaults, fiscal policies and sovereign supply, trade and geopolitical developments, or something else. You can let us know after the panel. We would always love to hear from you, of course. So while the audience is voting, Zach, what is top of mind for risk for you? Is it that Scott Bessent is the Fed chair?
That's on the bingo card, and that was one of my submissions. So I wouldn't rule it out. I think Kevin Hassett is probably in the leader spot still. But in terms of what I heard from, and we heard from the audience in London, number one was the AI pullback. Looks like that's kind of in the lead. That garnered 65% of responses, followed by fiscal and sovereign supply, which I don't want to downplay. I feel like we were beating that drum pretty hard last year, and we've taken it off a fair bit. It seems like, to me, what I've learned this year is, while you can hear all of this speculation about the U.S. dollar becoming the non-dominant currency, or we're kind of losing ground to the euro or the renminbi, whatever you like, that's really not how sovereign markets played out in 2025. And I think if you do have more of a global growth concern, the U.S. is definitely going to be the destination, even out to the longer duration parts. So that took 16% in London, followed by credit downgrades and defaults at 9%. Monetary policy mistakes at 9%, which I think is interesting, as it seems like there's growing comfort that global central banks, for the most part, are done easing, perhaps with the exception of the Fed, and are maybe looking to hike, at least for the Bank of Japan and maybe, I think, the Reserve Bank of Australia. And trade and geopolitical with 0% in London.
Trade and geopolitical is just fine. I guess this audience is a little bit more concerned about that, with 18%, and the old AI pullback at the top of the list, 49%, might make sense given that Oracle earnings yesterday didn't seem to please the market all that well. Pat, what is your kind of key risk for 2026?
AI actually figures in there. We mentioned earlier colleges and universities. The growth in the integration of AI is likely to influence new issue supply, especially in the public power sector. But again, thinking about colleges and universities, all the other challenges that they've got, demographic challenges, the political challenges, there's really not been a lot of attention paid to the modernization of the delivery of content in a college and university setting. that is absolutely ripe for change with the integration of AI into delivering content, especially lower division content. So I think the growth and the integration of AI is actually going to accelerate the pressure on the marginal providers in the college university space. It's not, again, it's not a large part of the issuing universe, but it's going to create headline risks that will ripple through and create some opportunities, quite honestly, for investors.
I think that's really interesting as we try to assess, how AI is going to kind of change everything. And I think that the biggest risk for global credit in 2026 is related to that as well in terms of, what really happens with the labor market. We know that labor supply has been tight. There's a lot of moving pieces as it relates to demographics and immigration. But we also know there was a lot of hiring during the pandemic and kind of the years coming out of that. We know that the unemployment rate for recent college grads is quite elevated. And as I think about kind of the AI cycle, it seems like a lot of institutions right now are very aggressively hiring for AI specific type roles, engineers, product developers, et cetera, but also making some room in their headcounts and thinking about who are we not necessarily going to need. And while they might not have a high conviction view on that quite yet, they're not really planning to robustly hire. And as I think about AI in the near term, it feels a little like a lose-lose. Either it's going to totally revolutionize everything right out of the gate, and that does have some implications for the labor market. I know a lot of people have been kind of talking about that. Some people saying unemployment rate going as high as 12 to 15%, which I don't think is going to be the case, but it is kind of an interesting reference point. Or this return on investment is not going to be quite as robust in the near term. And that has pretty meaningful implications for equity valuations, which has implications for the wealth effect that we've seen. And it kind of gets into a little bit of a vicious cycle there. So that's definitely on my kind of risk radar. I also want to highlight that Logan Miller, our Euro strategist, he does have a call for higher bond yields next year. So from a sovereign supply fiscal policy expectation, he's a little bit more cautious on that trade overall. I think that he put on his bingo card higher bond than U.S. Treasury yields for 2026, which I think would be a very interesting one. So, with all that in mind, what to do, Zach? What do we do here?
What to do? That is the big question. I'd say, actually, if we want to go to the next slide,
Sure.
Winnie, I'll kind of just go through. Everyone here knows that spreads are tight. The curve is relatively flat. For us, for excess return investors, we think the sweet spot is the 3 to 5 year space. We like moving up in duration in general in this spread decompression trade. I'd kind of consider our views more of a mean reversion trade as well. You can kind of see in the middle chart just how cheap the 3 to 5 year sector looks relative to its historical norms. I think it's even a little cheap to the 1 year average, whereas the 10-year plus side of that is kind of the reverse side of the coin, which has richened fairly substantially, and we think looks quite unattractive from an excess return perspective when thinking about spreads widening to 120 basis points. You're definitely going to see some pain in the 10 plus year part from an excess return perspective. And we kind of have a similar view when thinking about the ratings curve and how we want to position there. Looking at single A's, they look relatively cheap, again, to the long-term average as we just had a lot of spread compression. And thinking about triple V valuations, the last time they traded this rich was in late 2021. I'm sure I don't need to remind anyone in this room what happened in 2022 in financial markets. Certainly a painful year. Obviously, we're not calling for the Fed to hike 500 basis points next year. So you're going to need to see something a little different, drive spreads wider. But we do think that there's a lot of vulnerability to there. Our analyst, Luke Jensen, did a lot of great work looking at forward excess returns when spreads are at these tight levels, really across the duration and rating spectrum. They range from, I think, negative 90 basis points to negative 210 across ratings, and as bad as negative 300 basis points for the very long end. So we're kind of keeping that analysis in mind. And then you can kind of just flip that all on its head for total return focused investors. We like kind of moving out the curve as you think you get good price return. I think I failed to mention that our 10-year target is 3.5% for the end of 2026. That's the consensus is around 4%, forwards around 4.3%. So that definitely got the pens moving in London when I mentioned that one.
Great. And I also want to highlight that, in 2026, we do think that sector strategy, single name, that's going to continue to be a driving factor in portfolios. It certainly was this year from an out and underperformance standpoint. And we see reasons for that to become even more increasingly important. So just a plug for all the CreditSights analysts and all of their great work they do, trying to look ahead and see what's next for RelVal and fundamentals. So Pat, do you have a top muni trade for 2026?
Well, I want to point out, we've heard Zach say we're looking for lower treasury rates in 2026, but wider investment grade spreads. A lot of the muni market, the tax-exempt market, likes watching the muni to treasury yield ratios. I think that's going to be less helpful in 2026 than that generally as a relative value indicator, because the fall in treasury yields is going to make that relationship a little bit cheaper. It's going to make munis look a little bit cheaper. But relative to corporates, I don't think that will be the case. Where munis are right now, munis are priced in the first 10 years of the curve 100% right on top of after-tax corporate yield curves. The comparably rated curves are right on top of each other. So if investment grade spreads widen a little bit and the corporates get a little bit cheaper, munis, I think, will follow a little bit. So I think we're going to see slight underperformance of munis from a total return perspective versus treasuries. Should be fairly competitive with corporates, however.
All right. And as our ETF guru, what kind of practical advice do you have for potentially using ETFs to enhance a corporate portfolio for
Sure.
2026?
So one of the themes that I've gone back to again and again for years is the importance, in my mind, of using ETFs as a complement to a bond portfolio. I really like ETFs, the large liquid ETFs, as a way to diversify liquidity risk in a portfolio. And so whether you're an IG, high yield portfolio or a tax-exempt muni portfolio, you can use these, the ETFs as an alternate source of liquidity. And you can also use them to dial up or down the characteristics of risk in a portfolio. So if you're an IG portfolio and you want some incremental credit risk, well, you could use HYG to add some incremental credit risk. These three ETFs Zach and I have written about, we find them to be really interesting. These are buy right ETFs that are wrapped around LQD, HYG, and TLT. And so BlackRock adds Euro style calls on these portfolios. So it generates covered call income. Because these are Euro options, they can only be exercised on the exercise date. So they can actually close the position before the exercise date to reduce the tax implications. So in a sideways market or a slightly declining market, if you already have a position in LQD, for example, you could supplement that or swap it out with LQDW, and you can see, how these have done the buy right versus the non-buy right from a total return perspective. Really interesting, addition, to consider for a portfolio of individual bonds.
Yeah, great. Good PA recommendation as well. And then from a hedging perspective, anything?
Yeah. So here, again, if you have HYG in a portfolio, if the market is moving sideways, you can write covered calls against HYG. JNK is actually the larger of the two large high yield ETFs, but HYG, the options market on HYG is enormous compared to JNK. And so that facilitates secondary market turnover in the ETF. And it also allows strategies that you can do overlays with the options, not necessarily with the ETFs. There are also options available on LQD, on MUB. They're not as large, and so consequently not as liquid and not as efficient, but HYG is particularly large and efficient. And of course, TLT, if you're using TLT to add some duration to a bond portfolio, you can also do that using some options.
Yeah,
We publish these tables generally in the U.S. Weekly Report.
2026 could be the year for that TLT trade.
Yes.
All right. So I think that we probably have time for maybe one question, if anyone has anything. We've answered all the questions. All right. Did you have something to say? Oh.
Just more specifically on what's driving the larger than expected spread widening. It's a combination of valuations and consideration of tax-exempt agent. Am I missing something?
I think just broad-based labor market weakness as well, kind of a slowing macroeconomic expectation with the consumer decelerating more than expected and the industrial side of the economy not really picking up enough slack. And in that, we do think that when combined with some of the intentional releveraging that we've seen and kind of the willingness to be a little bit more aggressive with balance sheets, that will result in kind of ratings outlooks being a little bit more negative, or even starting to see some true downgrades, maybe a little bit of a pickup in default pricing expectations. And as we see Treasury yields come down, we do think that there's going to be that recalibration in spread with investors wanting to have that compensation for risk, especially when we think about kind of the all-in yield buyer. All right. All right. Well, that will conclude our strategy panel. Next up, we are going to talk about the topic of the hour, which is From Grid to GPU, Risks and Rewards of the AI Investment Race. That will feature Andy DeVries, Jordan Chelfin, Andy Lee, and Eric Vega to talk all things utilities, tech, and AI infrastructure.
Thank you.
Thanks, everybody.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.